From New York City for our viewers worldwide, I'm Jonathan Ferro. Bloomberg Real Yield starts right now. Coming up, investors shaking off weak data, hoping to resolve lingering macro issues. As broader credit remains resilient, more cracks emerging in leverage loans. Looking ahead to next week's move, looking for clues beyond the next rate cut. We begin with the big issue, debating whether we've seen off the worst of it.
The U.S. is actually in a pretty good spot.
In the U.S., they're still falling right now with manufacturing.
Manufacturing is weak globally.
Are we going to see something as bad as 2015 in terms of a global industrial recession? Probably not.
Stagnation, not recession.
Numbers are going to be weak through the balance of the year.
If you look at the PMIs, you're starting to see some signs of a bottoming out.
If we continue to see PMIs and leading indicators decline, maybe there is some downside there.
The data is going to continue to decelerate sometime into the first quarter.
Maybe we get some good news in a trade deal out of China. Maybe we get some positive news out of Brexit. Maybe that leads to a short-term pop in yields.
There's no way that this thing is magically over and going to pop at this point.
We should see growth improving by the first quarter of this next year.
This could be the bottom, so it might just get better from here.
Joining me around the table here in New York, Colin Robertson of Northern Trust, Kathy Jones of Charles Schwab, and Jim Keenan of BlackRock. Kathy, let's begin with you. Have we seen off the worst of it?
It looks like maybe the worst is over. It doesn't look like it gets a whole lot better from here. So we're cheering the fact that it's not decelerating or continuing to decline at a fairly rapid rate. And maybe we've seen the worst of it. Particularly if we get a trade deal. We've got some lagged effect from the easing from both China and other central banks. So, you know, maybe the worst is over, but certainly the going forward is not going to be strong.
Jim Keenan, your thoughts?
Yeah, I think you got to bifurcate. I think the data is going to be mixed. I mean, I think there are components of the market or different regions that probably will continue to see weaker data or weaker news into the balance of the year. But I think there's a variety of data that will start to stabilize, and you're seeing that in already in corporate earnings. You're seeing that in some parts of whether it's PMI data or other things, you start to see a little bit of stabilization. And I agree with Kathy. I don't think this is about upside levels of growth. I think this is about reducing the probability of a recessionary risk.
A thing that we've ventured through pretty much through the whole week so far is sometimes the information content of how a market responds to data is more valuable than the data in and of itself. And a simple way of saying that this week is that the Treasury market rallies on bad news have been smaller than the Treasury market sell-off on good news. What kind of signal is in that, Colin?
Well, the signal there, and it's a little bit troubling to me because I don't really support it, is just that to your point that really we have seen the bottom. We have seen the worst of it. And I just think it's pretty darn early to think about that, okay, now it's going to be there's a light at the end of the tunnel and we're going to move forward. I think the Fed's still too tight. I think what they say next week is important. The market has set them up to easily say we're going to pause until after the first quarter of next year, but I'm not sure what they're going to say exactly. So I think we need to see that play out, and we'll have a better feeling of what things are going to look like after next week.
Kathy?
I would say that the market has incorporated so much bad news that it really couldn't continue to react to bad news any further. We do think the Fed will try to pause after this next rate cut. We expect the rate cut next week. We think they'll try to go on pause because the issue is the cost of capital is not the problem that's hanging over the world right now. It's not the problem in Europe, certainly. It's not the problem in the rest of the world. It's not the problem in the U.S. So further rate cuts may not do that much. And so I think they want to pause.
Hasn't been the problem through much of this year, Kathy, and yet they still cut twice and are set to cut again. Why does it change?
Well, I think they uninverted the yield curve, which was important. They got the Fed funds rate pretty close to the neutral rate or below the neutral rate, which takes them out of being restrictive in policy. And now they can say, well, we're neutral or even a little bit accommodative.
Jim, your thoughts?
Yeah, I mean, you came into this year with some cyclical downside risk associated to, just coming off of the 2016 rebound, right? And then you had, the tightening of the Fed in the fourth quarter. So I would say that the central banks, including the Fed, have been easing throughout the year, right? And you're starting to see, if you just look at financial conditions indices relative to economic activity, you've seen a pretty big divergence. So I would say maybe not necessarily the Fed, but I would say collectively all the central banks have been easing, and I think that ultimately should lead to a level of stability. There are certainly things for downside risk associated to that, but I think the Fed will be very reactive to that, or even proactive, associated to worry about what that looks for next year. And whether they stop or they keep going, I think is less important to me, because the trend is that they're going to be very accommodative. And I think from a stabilization of data, that's a pretty positive environment for not only credit, but I think you could ultimately see the equities melt up here in the end of the year.
We'll talk about credit and we'll talk about equities a little bit later in the program. Equities near all-time highs to end the week. Your thoughts, Colin, on the 10-year? You came on this program a long time ago when we were at 3 percentage points, maybe 12 months ago, saying 150 on the 10-year. We've reached that level. We're back to around about 180. You don't think the lows are in for this year, or do you?
I think the lows could possibly be in for this year, but I really like 10-year treasuries at 180.
You're a buyer at 180?
I'm a buyer at 180. In fact, if I gave you a range for the next 6 months, this would be the high. So it may be that we get new lows in the first quarter of next year, but just to give you rough numbers, 1.25 to 1.75, that would be my 10-year range, and that's for the next half year.
What is it about the economic conditions that makes you bullish on a 10-year at 180?
Sure. Well, number one, negative interest rates in a lot of places, seeing new lows in many countries with respect to where their 10-year rates are. We haven't hit that yet. But also, as I mentioned before, I think the Fed's too tight. We're basically where we were in June of last year right now. So if they ease one more, to me that would be the first ease, because as you know, me being on the show last year, I was dead set against the last 2 tightenings, and I think there were mistakes. And so I'm hoping that the Fed has figured that out, but I'm not sure.
Kathy, a buyer at 180?
We think fair value is right around 180 to 190 in the 10-year. Now, that being said, if the global PMIs actually turn up and just stop going down, that would raise our fair value, because that's a component of our estimate. But our range is closer to 1.5% to 2% for the next 6 months or so.
Jim Keenan?
Yeah, I would say long term it's okay, but in the short term, I think there's more risk that it leaks wider just on our stabilization of data.
Looking at the data so far through this week, PMI's not great. The EFO, there was this small ray of hope in German business expectations. But beyond that, Kathy, do you see any signs of stabilization?
Well, again, it's not deteriorating at a rapid rate. The slowdown has slowed down, so to speak. So that's somewhat stabilizing, but I don't see a lot of positive upside. I don't see a reversal in the rate of economic growth coming.
To revisit the start of this conversation, though, Kathy, the data in Europe hasn't been fantastic. Bund yields this week, though, nothing. Done absolutely nothing. The spread between the 10-year US versus Germany has really started to close up, approaching 200 basis points. Do you think that can go even narrower? And what kind of levels do you think this can go to?
Well, I do think it can go a little bit narrower, and probably not a whole lot, but you could see it move a little bit more. Just because if you have the weight of the Bund yield sitting there, that can pull on the U.S. yield and vice versa. But I don't think things are turning around in Europe. I think things are just not getting worse in Europe.
On that spread, Colin, your thoughts?
My thoughts are that it could still widen out a little bit, but ultimately, if the Bund starts to move down further negative in yield, I do believe it'll drag the U.S. with it, and I think that's part of what's not happening right now. Whereas if I say I like 10 years at 180, there's got to be a reason. One of the reasons is I don't think that drag is really in the market.
Guys, you're going to be sticking with me. Everyone around the table here in New York. Coming up on the program, the auction block, cracks emerging in leverage loans as investors begin to push back. That conversation is coming up next. This is Bloomberg Real Yield. Jonathan Ferro, this is Bloomberg Real Yield. I want to head to the auction block now and begin over in Europe, where Italy sold 3 billion euros of 2-year bonds. Demand for the zero coupon debt was about 1.5 times higher than the issuance, resulting in a yield of negative 0.11%. In the US junk bonds, seeing a flurry of issuance this week, with at least 7 deals pricing. Netflix and Liberty Latin America boosting high yield volumes to almost 4 billion on one day alone. And in leverage loans, an issuance to finance the acquisitions of a mattress maker Innocor had to offer one of the highest yields of the year at roughly 12.5% to close its deal. Sticking with loans, Barclays CEO Jez Staley saying troubled deals are an eye-opener.
What we've seen recently, however, is if you have a deal that's not structured properly, that has some idiosyncratic weaknesses to it, the market can be pretty punishing at the bottom end.
Colin Robertson, Kathy Jones, Jim Keenan still with me. Jim, let's begin with you. Your thoughts on loans right now. Just what is going on?
Yeah, well, first off, the loan market has structurally changed, right? You've had a market that has shifted from maintenance covenants to incurrence, so the old covenant light dynamic associated to that. But the credit quality has decreased as you've seen more LBOs come to the loan market, and inherently the market is more levered and it's a more riskier element. And then thirdly, I would say, instead of 2 years ago, we've had a rising rate environment, we've had an environment where LIBOR is declining. So all of those things are negative from a loan market perspective. So within the loan market, though, I'd say there's a couple different stories which are not different than the rest of the broader markets, including credit. Is higher quality is still doing okay. It's the lower quality part of the market which has grown that has really bifurcated and has been pretty negative. And so we continue to, I would say, be cautious across the market. And loans generally look a lot more like a secured high yield bond market than they did the historical loan market. So there are areas and pockets that you can find good spread and good risk in the loan market, but similar to the high yield market, you got to be careful.
Kathy?
We haven't liked the loan market for quite some time. First of all, why are you buying loans when rates are going down?
Well, that would be my question. Is this about floating rate? The pain we're seeing at the moment, is this about floating rate and no appetite for it, or is some credit risk building?
I think both. Both. You've seen a decline in credit quality, and you've seen falling rates, and this covenant light business, you're finally seeing investors push back on it and deals not getting done. So the combination just says, why be in the loan market?
Colin?
Well, I think Jim's point about finding the right bonds is really the most critical piece of the puzzle. So in general, don't like leveraged loans. But, again, the point Jim made about it now looks more like the high yield market, well, you just got to be careful and make sure that you're involved in the right securities, that, okay, I'm getting paid for the fact that these securities now look like true high yield.
Some of the issues, Jim, that we're seeing in leveraged loans right now are quite similar to what we saw at the end of the year, the back end of 2018. What's intriguing about it, though, is that the back end of 2018, more broadly, the fixed income environment was a bit of a mess. The primary market had completely shut down. We're seeing these issues this time around when the rest of the fixed income universe is doing pretty decently and spreads are still tight. What does that tell you?
Yeah, well, first off, I disagree with the comment. When you look at the underlying, if you looked at double Bs in high yield, they're at their kind of their 2 percentile of the last 10 years. Like the spreads are at their tights. When you look at triple Cs in the high yield market, they're at their 75th percentile. Right, so there's a lot of bifurcation in the high yield market. If you look at energy, it's towards its wides and is really weighed down on parts of the high yield market. So you're seeing the same thing in loans. You just don't see the same differentiation of return because it's a front end spread product, right? So I think in the loan market, as we talked about, credit risk has increased. And there are certainly areas of the loan market that I think you want to be careful of negative convexity, meaning that when there's an earnings miss, it is going to trade similar with downside risk like a high yield bond. And there are others that it's not about the floating rate, it's where can you find good spread risk, right? Where are you finding good securities that ultimately can achieve returns? And you should be able to find a 4 or 5% return in the loan market. I wouldn't necessarily look at it and say buy it in isolation. I think that across the markets in credit, there's a lot of dispersion. And if you can utilize the high yield or loan or different regions, you can really capitalize on that, basically creating good income and avoiding downside risk to bad business models.
Kathy, build on that.
Well, I disagree, to be perfectly honest. I think it's when and if the market turns, this differentiation isn't going to help a whole lot. And so the loan market being as it is, I would say you're better off moving into high yield than you are staying in the loan market.
Looking at high yield through this year, we've had 3 scares. We got close to the tights of the year in and around 350. Spreads blew out. Didn't even get to 450 this time around, Kathy. What does that tell you?
It tells you that this search for yield is still really intense. And as the Fed lowers rates, people are going to continue to pile into things that offer yield irrespective of the quality. And that's why we've been pretty cautious on high yield as well for the last 6 months or so.
Any reason to believe that demand goes away, Jim? Every time there's a scare and spreads start to break out towards 450, the buying comes back in. Any reason to believe that goes away anytime soon?
Not at the micro level. I think those are macro factors that are what could potentially pull the market into a recession. And if you have a recession, I think the broader credit spread markets will sell off. So we still put a lower probability to that, but when you think about those scares that have really pulled the triple B market or the double B market down, it's really a fear of an earnings recession or an economic recession, and I think those are the things that you want to watch. Again, I think, as we can talk about the loan market being negative, it's still up 6% for the year, which is a pretty good quality return when you think about all of the negative noise around the whole space.
Final word here, Colin.
Sure. Insatiable demand for fixed income, insatiable demand for high yield fixed income. And not like the old days when a high yield portfolio manager in a time of stress, you mentioned the times of stress, would be worried that they can't raise enough liquidity. High yield portfolio managers now are scared. I can't get those bonds back if I sell them. That's a huge transformation in the markets right now. Very supportive of high yield. We like high yield, and I think that's going to continue into next year.
Guys, going to be sticking with me. Coming up on the program, still ahead, the final spread, the week ahead, featuring a Fed rate decision and US payrolls as well. That conversation is coming up next. This is Bloomberg Real Yield. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread. Coming up over the next week, it's crunch time for Brexit, with the UK deadline coming on October 31st. On Wednesday, rate decisions from the BOJ and the Fed, plus another J-Powell news conference. Then on Friday, Vice Chairman Rich Clarida will be speaking just after the US GDP and the payrolls report. Still with me, Colin Robertson, Kathy Jones and Jim Keenan. Guys, let's look ahead to that payrolls report. Colin, you are looking for a really, really bad number next Friday. Why and what?
Well, I just think, again, with not a lot of support, that things are getting better. I think that the forecast will have overshot where we'll be. So at about 85,000, I would be much more inclined to think it's going to be closer to zero than 85,000. And also, importantly, I want to see the revisions because that would feed into my thought process that things look better than people think.
Where would you be looking elsewhere outside the headline number to see that kind of stuff?
To see that things look not as good?
Yeah.
It would be the revisions coming down.
Just on the headline number, though?
Yeah.
Not in hours worked, nowhere else in the payrolls report?
That stuff to me is messier. I want to look at the more specifics of the headline.
Kathy?
We're looking for slightly under the consensus, closer to 70 or 75 than the 85. But it will be a messy report because of the GM strike and several other factors. So even in the hours worked and average hourly earnings, it may be kind of hard to parse through exactly what's happening. But it's slowing down. I mean, employment growth is slowing down. We know that.
Jim?
Yeah, I think obviously because of manufacturing, some of the things in the autos, and I mean, we've seen it through a lot of the data, it's going to be a weak number. That being said, I would somewhat look through it, and I do think that average worked. And I mean, the consumer has been a positive story in this whole thing. So although I think jobs are slowing down, I still think the consumption and the consumer is still in a good place.
We've got to get to a Fed decision first next Wednesday as well, Jim. 75 basis points is what most people considered a mid-cycle adjustment to be. If we get another cut this coming Wednesday, that's 75. How does the Fed communicate that they may well be done here without upsetting this market?
Well, I think they'll cut, and I don't necessarily think they'll say they'll be done. I think the Fed has continued to move towards the language of being more data dependent. And we all can look into the next 6 months. There's a lot of different things going on between trade uncertainty, the election, that can create a variety of different outcomes. So I think they'll leave a lot of optionality open, but I think that language will be important on how the markets will trade in the short term.
Kathy?
Yeah, I would agree. I think they'll try to go on pause, but I don't know that they'll actually communicate that. I think they'll try to communicate that, okay, we're done for now, and we're just going to wait and see. But I think their inclination is to try to stop after this if they can.
What do you think, Colin?
Yeah, I think they've put themselves in a position where they have to lead the market into thinking that they're still data dependent, which I don't really like, because I'd be happier with them if they were actually forecasting or entrusting their forecasts. Data dependent doesn't tell me a lot, and when they talk after every meeting, that doesn't help me a lot either. So the bottom line is, I think they've painted themselves in a corner, and they're going to have to position it that, no, we're not really done or pausing necessarily. We're not sure. Let's go from here.
They're data dependent. This is a question that's come up so many times on this program over the last few years. Which data are they dependent on?
I think it's inflation, and I think it's growth. But I also think that they now take into consideration global growth versus just U.S. domestic
You've got
growth.
a decent handle on that, Kathy.
No, and I would say I don't think anybody really knows all of the sum of all that they're looking at, I think. They talk about inflation being below their target, but many measures of inflation that the Fed produces are well above 2% already. So it's hard to know, is it just core PCE that matters, or is it other data? They talk about the employment situation, and some still believe in the Phillips curve. Some don't believe in the Phillips curve. They talk about the global headwinds. So we know those, headwinds will be stronger sometimes and weaker at other times. So do we really know exactly what they're looking at? I don't think so.
Reaction functions evolve. That's, I guess, the nature of central banking. But Jim, do you understand the reaction function currently at this Federal Reserve?
Yeah, obviously, I think there's still room and capacity just because the aggregate debt in the system is still a deflationary aspect of that. But I think what is also this Fed is looking at is labor, right? And I think some of the inflationary data, if it is labor income that is increasing, and that can hold up aggregate demand, I think this Fed will be willing to run with inflationary data that's higher. They still haven't been able to get it there, right? And so I think, for the last 10 years, corporate profit margins have benefited. If the next 10 years you see some labor inflation at the expense of profit margins, but aggregate demand holds, I think that's still a pretty positive story from a Fed perspective.
Guys, we're going to do the final round now, the rapid fire round. We will do it with a Fed twist on this going into next week. Is the Fed one and done for 2019? One more cut and done for 2019? Yes or no? Kathy?
Yes.
Colin?
No.
Jim?
Yes.
No forecast, no summary of economic projections at the Fed's meeting next week. Does that help or hinder Powell's communication effort? Help or hinder? Jim?
No.
Colin?
Hinders.
Kathy?
Helps.
Third and final question for you all. Expectations for next year from the Fed. No cuts, one cut, two cuts, or more. No cut, one cut, two cuts, or more. Colin?
Two cuts.
Kathy?
One.
Jim?
One.
Guys, great to catch up with you all. Colin Robertson, Kathy Jones, Jim Keenan, always great to get your insight on this program. From New York City, that does it for us. We'll see you next Friday at 1 p.m. New York time. That's 5 p.m. in London. From New York, for our audience worldwide, this was Bloomberg Real Yield. This is Bloomberg TV.